So Starbucks, you sold beverages and food on site. That revenue, what was it? And then what were all your expenses? And when you subtract all those expenses, did you end up at the bottom line with a profit or a net loss? In this lesson, we'll look at the annual report known as the 10K. And for our purposes, we're going to focus just on the three financial statements: the income statement, the statement of cash flows, and the balance sheet. When a company goes public, they perform an IPO, and that offer is registered under the Securities Act of 1933. Going forward, they're a reporting company under the Securities Exchange Act of 1934. And at a minimum, they do 3 quarterly reports known as 10Qs and 1 audited annual report known as a 10K. In the annual report, anybody with curiosity and also the shareholders can see what the issues are facing the business. Maybe they're still shutting down stores or shutting down non-productive oil wells, whatever it would be. The financial reports that we're going to look at in some detail, the company might be a plaintiff or a defendant in lawsuits. We get details on executive compensation, and that includes stock options and restricted stock and so forth. And then we can also see who the large shareholders are and how much they own. Supermarkets and other institutional sales, that revenue, what was it? And then what were all your expenses? And when you subtract all those expenses, did you end up at the bottom line with a profit or a net loss? I don't know if they've had a net loss in many, many years. So the result of operations is what we're talking about here, the income statement. Your revenue or sales minus all your expenses. The bottom line is either a profit or a loss. So revenue is the top line. We took in this much selling products. And then we had expenses, anything from the ingredients to the labor, to the leases or mortgage payments, to the maintenance of the parking lot, the equipment, etc. We even subtract the interest that we would have paid on bonds. And if we pay taxes, we subtract that, and then we arrive at the net income, or sometimes net loss, but that's the bottom line. So revenue is the top line. What are you left with on the bottom line? That's your net income. And from this income statement, a few of the key metrics would be the gross profit, and then the gross margin, as well as the net income or net profit, and then that as a margin or percentage. So margin means percentage, whereas the others are dollar amounts. Take your revenue minus your cost of goods sold or cost of revenue. So you served up that coffee, but what went into it? Flavorings, beans, the labor of the barista, the cup, the sleeve, etc. That all is part of cost of goods sold. And then take that gross profit as a percentage of revenue. Why? Well, if you're going to open a restaurant and you're going to sell sandwiches for $9, but the cost of goods sold is $7, that business model is never going to work. Net income is revenue minus all expenses. And then that divided back into revenue. And what would this look like for Starbucks? Well, their revenue is $24.7 billion minus the $10.1 billion. So that difference of about $14.5 billion is their gross profit. And then if you take that number and divide it back into the net revenues of $24.7 billion, it becomes 58%. So the gross profit is we can just lop off some numbers. 24 minus 10, it's 14 billion. And then if you take that 14 divided back into 24, you see that it's about 58.8%. Of course, the main success is what we end up with on the bottom line, which ended up being, without getting into a lot of details, about $4.5 billion. So the net income really jumped quite a bit from the year before, which was $2.8 billion. And if you're a common stockholder, this is what you're dreaming of. The sales and net income growing at a rapid pace. That's all you really have with the common stock. So the company showed net income of about $4.5 billion. Shareholders have a claim on those earnings. So if you divide that by the shares, you get about $3.24 per share. And so what is that net margin? You just take the 4.5 or 4,518, divide it back into the 24,719, and I think it's about 18%, which for a restaurant is extremely good. So the company showed net income of about 4.5 billion. Shareholders have a claim on those earnings. So if you divide that by the shares, you get about $3.24 per share. And then we could go see what the stock price close at, how many times the earnings, price to earnings ratio. There's a lot of number crunching involved with what we're doing here, which could be referred to as fundamental analysis. We're not analyzing the way the stock trades on the market. That's technical. We're actually rolling up our sleeves and looking closely at the financials of this company. So 4.5 billion was their net income. Is that the same as the cash that they provided? No. We see that on a separate statement of cash flows where we actually start with the net income and then we make some adjustments. For example, I noticed there was over $1 billion in depreciation. That's an accounting subtraction. And what we're doing there is taking, for example, an expensive piece of equipment, estimating its useful life, and then subtracting that over the period that it should match up with on the income statement. So it's not actual cash. So we're going to add that back and do a few other things. But the company either provides or uses cash by running the business operations, probably the most important. But also an analyst might want to see, now how much of your good news is just the fact that you took in a bunch of money by issuing bonds that you'll have to pay back or selling off assets as a one-time event. But the cash that's provided or used by investing doesn't mean securities. It means investing in the business by purchasing equipment or selling off assets. Financing is where we're talking about the issuer's securities. If they issue stocks or bonds, a bunch of money came in, and we would see it here. Or when they pay out interest and dividends, that is a subtraction, obviously. And if bonds are maturing, they have to redeem the bonds, and that's a huge payout of cash in terms of the par value. And then I noticed with Starbucks, they're also repurchasing stock. So the balance sheet is the statement of financial condition, and it has to do with the difference between what we own and what we owe. What we own, assets. They own a lot of their stores, and they own all this equipment, and they also actually have quite a bit of money invested in securities. A lot of companies have an interest expense. They usually show interest income from all their short-term securities. But like anyone else or any company, they also owe. These are their liabilities. There's a mortgage balance on these stores that we own. We have to pay out the par value of these long-term bonds. In the short term, there could be wages and taxes to pay, etc. But the difference between what we own and what we owe would be usually not called the net worth, but on a test question, it could be. In the so-called real world, usually stockholders or shareholders' equity. And from the balance sheet, we get a little bit more detail. These assets are either current or long-term, and they could even be intangible. Not all companies have intangible assets. But if it's cash or it will be cash in the short term, that's a current asset. If it's something that's going to be around for a long time, something that we end up depreciating like equipment or real estate, that's a fixed asset. And then when Starbucks purchases a coffee or tea company, they pay more than just a hard tangible asset value. That premium is known as goodwill. And from the balance sheet, we get a little bit more detail. These assets are either current or long-term, and they could even be intangible. Not all companies have intangible assets. But if it's cash or it will be cash in the short term, that's a current asset. If it's something that's going to be around for a long time, something that we end up depreciating like equipment or real estate, that's a fixed asset. And then when Starbucks purchases a coffee or tea company, they pay more than just a hard tangible asset value. That premium is known as goodwill. On the other side, liabilities. So anything that is going to be cash coming towards us in the short term is a current asset. Anything we have to pay out in the short term is a current liability. So accounts receivable, that's a current asset, but accounts payable, that's a current liability. If we have an interest payment coming up, that would be a current liability. But if these bonds mature in 3 years, the par value is a long-term liability. And then the difference between assets and liabilities either net worth or called shareholders' equity. And under here on the balance sheet, the issuer lists the par value of the common stock. Starbucks, I noticed, was 1/10 of a penny. When they sold the stock in the IPO, all of the price that was paid above that is the additional paid in capital. And then we saw the 4.5 and the 2.2 billion of net income. Think of all the years Starbucks has shown net income. They've only paid out a little bit as dividends. Everything else is called retained earnings. And from the balance sheet, we can get a look at some important metrics, including working capital. That's a dollar amount. It's current assets minus current liabilities. The current ratio, current assets to or divided by the current liabilities. I noticed with Starbucks, they had 6.9 billion. And when they took the current assets divided by or compared to the current liabilities, it was 2.2 to 1. What do you mean quick ratio? Well, quick ratio says take your current assets, but just to be more stringent, subtract inventory, and then compare that or divide that by the current liabilities. And with Starbucks, they had $1 billion in inventory, and because maybe they won't sell that inventory, they've had product flops, or they could, it was still 2.1 to 1. So, but for some companies, having too much inventory could be disastrous. So let's be more stringent and call it a quick ratio. The book value, you may have heard of the price to book, the price to earnings. The book value is the hard, tangible asset value that is connected to a share of stock. All right, so the annual report, known as the 10K, has to be audited by an outside accounting firm. And among many other things, we can find the financial statements. Did you make your numbers? What was the sales? What was the profit for that period? Income statement. And then also, well, what's your gross margin or your net margin? Cash flow, did you provide or use cash in 3 different ways? And then what is the snapshot of your financial condition right now, the balance sheet? And we can look at things like working capital or current ratio.